So I just realized I've been muted this whole time. Let's start from the beginning. All right, so I'll be starting this this session. Again, we'll be looking through data from the ABS, Australian Bureau of Statistics. The total value of dwellings, basically looking at the markets from a broad level across Australia. Bear with me, I'm also quite ill here. Looking at the markets across Australia from a statistical perspective. All right, so we've got the median house prices here. Actually, first of all, I'll also say my name is Tim Gilderdale. I'm a property consultant with Positive Real Estate, we'll jump into the presentation. So median house prices here are listed on the screen. We've got Sydney as the most expensive market. We've got Canberra in second place, and then recent changes been having Brisbane, Adelaide, and Perth in third, fourth, and fifth, with Melbourne coming in sixth place now. We've got Hobart and Darwin following behind. We've got median house prices listed on the screen here, going all the way back to 2002, where the current data regime began. So as you can see here, one thing to point out will be basically this blue line here for Sydney. You'll see that whenever the rest of the cities start to catch up to Sydney, Sydney will have a bit of a boom, and it will start to show tremendous growth and move a bit away from the rest of the cities. There's also a few other patterns here as well. So when you see Melbourne and Brisbane coming close together, shortly after you'll have Melbourne kind of have a bit of a boom. When they come back, we could probably expect another bit of a boom in Melbourne once they start to meet up, after they have met up, like they did back in 2023. Similar sort of story with unit prices. We've got Sydney as the lead market. Then we've got Brisbane in second place at the moment, then Adelaide. We've also got Melbourne just in front of Perth for now. And then Canberra, followed by Hobart and Darwin. You'll see similar sort of price behavior here with the unit prices. The Sydney market's the lead market. When other markets catch up, the Sydney market starts to boom ahead a bit. And you'll see similar sort of price action with Melbourne as well. When the other cities start to catch up or even take over, quite often you'll have a bit of a boom in Melbourne's market shortly following after. All right, so what we have here is relative median house prices. So what we're looking at is looking at where these cities are at the moment compared to their long run comparison to the Sydney market. So we can see the Sydney long run average ratio in blue, and then in green you'll have the current ratio. So this will be basically looking at the market in green, Adelaide here, divided by Sydney prices as the current price. So at the moment, we're seeing that over the longer term, Canberra is a little bit below its long run average as a price comparison to Sydney. If you're looking at a mean reversion strategy, that would mean that you might expect the Canberra market to play a bit of a catch up, or the Sydney market to slow down a little bit. There's not much of a gap there. Wouldn't necessarily put much down to it just yet. But when you look at a market like Darwin, you might think that there is a bit of catch up for Darwin to play in this situation. If you look at the if you're looking at the Darwin market, you're probably looking at there's been quite a bit of growth in the Darwin market recently. That's the best way to phrase this. So we've got Sydney here, we've got Melbourne here. If you're comparing to Melbourne, you'll see that Perth, Adelaide, and Brisbane have been outstripping Melbourne quite significantly, with their current price ratio well above their long-term average ratio. You've got the Sydney market outstripping the Melbourne market as well. However, you've got Darwin a little bit behind, and you've got Hobart a little bit in front and Canberra a bit in front of Melbourne. So once again, looking at Sydney, you can see that Perth's a little bit behind, Adelaide's a bit in front, Brisbane is in front of its long run average. I believe looking at this, that Brisbane's probably still got quite a bit of a run to go. It is going through a change in its classification from a second tier city to a global class city as it approaches the Olympic Games. And that means that it is going to have some short-term outperformance. It is expected to have short-term outperformance, but over the longer term, you might see that its long-term average ratio will start to creep up as it becomes more normal. If you're looking at unit prices, you can see that it's fairly similar sort of relationship to what we have on the left, except for we have Perth, Adelaide, and Brisbane unit markets. They've just gone through a period of going gangbusters at a time when the Sydney markets haven't been growing as fast. And we can see that the Melbourne market's been a little bit sluggish as well with units compared to Sydney. If we're comparing to Melbourne, you can see just how much more pronounced these effects are. The recent experience in Perth, Adelaide, and Brisbane. We've got a comparison here to Brisbane as well, just to see how it's outperformed a lot of these markets recently. So we'll have a look at the correlation matrix here. So what we're looking at here, generally with correlation, anything over 0.7 can imply some degree of, fairly strong correlation, something that's, worthy of classifying that way. Something below 0.3 will be probably not much correlation, which, if you're looking to diversify your portfolio, can be a good thing. Between 0.3 and 0.7, there's not really a whole lot to classify. It's not strong correlation. It's not a lack of correlation. It's kind of weak. And you probably put that down, especially when you're looking at the housing market, specifically for houses, that this will be just a commonality from macro factors affecting the broader market across all these cities. Things like interest rates, availability of credit, that sort of thing, even potentially development policies and the like. But what we can see here, a few interesting relationships: Sydney and Melbourne, the highest correlating markets at about 0.8. You've got Brisbane and Adelaide here, fairly high correlating markets. Then there's not really much correlation. And then you've got, the Darwin market, which doesn't really even have, small levels of correlation that much with other cities. Just does its own thing. Not really phased with what's going on in the rest of the country. If we have a look at the unit market, you can see this correlation is dropping significantly. So there's still a bit of a relationship, possibly, kind of between Sydney and Melbourne at 0.6. They do correlate the most out of all the markets with units. Brisbane, Adelaide at 0.317. You've got Perth here and Brisbane correlating a bit with their unit markets. But the rest of it is pretty much a complete lack of correlation. And the reason behind that is because these markets, these unit markets, are a lot more dependent on micro factors, local supply and demand factors, rather than macro factors. So there's no real micro factor that's tying apartment supply, in the suburbs of Brisbane to the suburbs of, to Sydney. So I guess the key takeaway in that is Sydney units can be a useful way to diversify your portfolio, but you really want to be careful with what you're getting into because it is quite susceptible to those micro factors. If you want something that's going to outperform, you've got to pay attention to those micro factors in the local environment, demographics, local economy, employment drivers nearby, all that sort of thing, infrastructure in the pipeline. So looking here at houses again, we're looking at the performance evaluation of houses as an asset. So looking at, price growth, standard deviations. There's a whole bunch of text here. I won't go into too much detail about it. A few things to point out though is looking at these downside deviations. This is probably where some of the key things to point out can be. So I don't see a risk being, an asset having a high chance of upside potential. I think that the risk that should be measured is the relevant risk will be the downside risk. So while you're always going to have upside and downside, and markets will go up and down, it's not always up. It's interesting just to have a look at what this downside risk is. So if we're looking at these ones here, so below the average growth rate or below zero, we can have a look across these cities. We can see that our global cities have more downside risk, and you'll see that they also have more upside risk as well. That's just the way that they operate. Downside risk, you've got Brisbane having much less downside risk, Adelaide having less downside risk for houses, Perth has a bit, Hobart has a bit, Darwin has a bit, and Canberra has a bit. But for limiting downside risk, Brisbane and Adelaide, at least the recent price experience has been that way. As Brisbane becomes more of a global city, we will expect this to jump up a bit and become a bit more downside volatile like Sydney and Melbourne, but still going through that initial growth phase to the point where yields are falling. So basically it just describes, where you'll have the big upside risks. This would be the Brisbane market here. I won't go into too much detail with that. It's a bit complex. So we've got the distribution of our cities. You can see that Sydney has quite a wide distribution. This is its high standard deviation, downside risk and upside risk. Take note of the numbers on the left column here. They do differ for each city. Melbourne as well, it's got that wide spread of returns. So we're looking at quarterly returns and the number of quarterly returns that we've had since 2022. And then we're looking here at Brisbane. You can see that Brisbane's price growth, it's a bit narrower, but with a bit of an upside kick. So when we're looking at this, we're looking at this leptokurtic kind of peak with a positive skew on the right-hand side. Note it goes up to 25 here. So it is a bit taller. You'd expect it to be like that if they were normalized or equalized. So looking at Adelaide houses here, you can see, a bit of only a small bit of downside, quite a bit of upside. Its recent price growth experience also does have an impact on these numbers. We've got Perth experience here. It does have a bit of a downside from time to time. It can have a prolonged downside as well, but it also has a bit of upside in the quarterly numbers. We've also got Hobart here, which has had significant downside, but significant upside relatively. And then Darwin and Perth. See Darwin here, quite a bit of downside potential. And over in Canberra as well, it has had a couple of quarters where it's quite a bit on the downside. So if we have a look at unit prices, fairly similar sort of behavior. Probably slightly less volatile, except for some of the apartment markets. Hobart and Darwin's apartment markets are more volatile with units on the downside. So if you have a look at the distribution here, we've got Sydney at the top, much more narrow distribution of returns than the housing market, same with Melbourne, and same with Brisbane as well. Got Adelaide, Perth, and then you've got a few outliers, with Perth and Hobart here, and even more with Darwin. So what does that mean for your portfolio? Well, basically these stats, it can help with your understanding as to the risk of what you're getting into as an asset. And when it comes to units, I'd say more the risk of really needing to know what you're getting into if you are jumping into a unit. You don't want to be having these quarters like this in a city like Darwin, where you're dropping 20% in a quarter. That is outrageous. It is very dependent on micro factors, so you want to make sure that you are aware as to what the demographics are. You're considering infrastructure, you're considering supply and demand elements. Pretty much, exactly as our acquisitions team does here, vetting opportunities that don't stack up and positioning your portfolio for longer term growth. And also the benefits of diversification as well. When you're looking at returns like this in the unit market, it is great for diversification. When you're looking at this with housing, there is potential for diversification there as well. Even among the major cities, like great potential for diversification, especially in the ones that are, below that 0.3 mark, or I'd say, even sitting around that 0.5 mark offers a great opportunity for diversifying between cities, considering that macro factors do push a lot of this price data. All right, that'll be it for me. I appreciate you joining, and if you do have any questions, feel free to reach out. Once again, the name's Timothy Gilderdale, property consultant with Positive Real Estate. I look forward to hearing your feedback. Cheers.